This program was brought to you by PennyMac TPO. Visit tpo.pennymac.com to learn more about becoming a partner and starting your journey to greatness. With the people, products, and technology to take you there, it's why they say, at PennyMac, greatness lives here.
This is The Interest. I'm Christine Stewart. Markets have been waiting all day to hear how high the Fed would hike rates to knock down inflation. The news is in. Our own Mike Savino spoke to two economists about the impact the decision will have and why the Fed was more aggressive than previously forecast.
The Fed has been very methodical in its approach and very thoughtful.
Experts were ready for the Fed to raise interest rates by 50 basis points today, but the Fed threw us a curveball, approving a 75 basis point hike. Experts say this is a response to some recent news that past hikes haven't been enough.
It's like an 11th hour decision, it seemed like, from the Fed.
Experts told Mortgage News Network that the prior 50-point hikes were working and that retail spending in particular was starting to dip. But the Fed was driven by two numbers, the CPI reaching 8.6% last week, and a University of Michigan survey showing more consumers becoming pessimistic about inflation.
Over the years, the Fed has learned that keeping inflation expectations anchored is really, really important.
So what does this mean for the housing market? The higher than expected hike alone likely won't do much to push mortgage rates up. But experts say lenders will be watching the Fed's economic forecast and any indicators that future hikes will also be higher than expected.
It's going to be very hawkish, and that could drive long-term rates up even higher, which means mortgage rates over the next couple of weeks have nowhere to go but up.
At the same time, factors outside the Fed's control keep pushing up prices, especially gas and other energy sources. That makes it harder and harder for consumers to afford the combination of rising prices and mortgage rates.
We're seeing people reallocating their basket of goods, which has to have an impact on disposable income available for mortgage.
For the Mortgage News Network, I'm Mike Savino.
Mortgage applications increased 6.6% last week. The refinance index also increased 4% from the previous week, but refinance activity continues to run more than 70% lower than last year. That's at the same time as mortgage rates increased for all loan types. The 30-year fixed rate jumped to 5.65%, the highest level since 2008. The MBA says purchase applications were down more than 15% compared to last year, as ongoing inventory shortages and affordability challenges have cooled demand, coinciding with the rapid jump in mortgage rates. And finally, it's just a sign of the times and the economy. Compass Inc., both online real estate brokerages, each announced workforce reductions this week in filings with the Securities and Exchange Commission. Redfin says it's laying off 470 workers, or about 6% of its total workforce. Compass says it would cut 10% of its workforce, or about 450 jobs. The layoffs by Redfin and Compass come just under 2 weeks after loanDepot announced an undisclosed number of layoffs, and Mr. Cooper Group laid off 420 employees.
This program was brought to you by PennyMac TPO. Visit tpo.pennymac.com to learn more about becoming a partner and starting your journey to greatness.
For more on these and all of today's top stories, go to mortgagenewsnetwork.com.